All right, so are you ready for this? We're going to take a deep dive into the world of accounting today.
Sounds a bit dry.
Maybe, but trust me, it's more interesting than you might think. We always start these deep dives with something you've sent in, and this time you've given us some excerpts from, well, from an actual textbook.
A financial accounting textbook, to be precise.
Yeah, it's called Pasted Text.
And we're going to unpack some of the key ideas from that book.
Exactly. We're going to break it down and show you how accounting is, well, it's like a secret code that unlocks the financial health of, well, of any business.
It really is the language of business.
Yeah.
And once you understand it, you can gain some really incredible insights into how companies operate and how they're doing financially.
Okay, so let's start with the basics. What is accounting? Why should we care about all this?
Well, the textbook defines accounting as the process of identifying, measuring, recording, and communicating a company's financial activities.
Okay, but what does that actually mean?
Think of it this way. Every business, big or small, is constantly making decisions, like buying inventory, or paying employees or investing in new equipment. All of those decisions have a financial impact. And accounting is the system we use to track those impacts and then turn them into meaningful information.
So it's more than just crunching numbers, it's about telling a story.
Exactly.
And who's the audience for this story? Who's listening?
Well, on one hand, you have the internal audience, the management team within the company. They rely on this accounting information to make strategic decisions. Like whether to launch a new product line or to expand into a new market or even just to figure out if they can afford to give their employees a raise.
Right, and then you've got the external stakeholders too.
Oh, absolutely. Investors, for example, they want to know if the company's profitable and if it's growing. Creditors need to assess the risk of lending money to that company. And even potential employees, they might look at a company's financial health to kind of get a sense of its stability and its future prospects.
So accounting helps everyone involved, both inside and outside the company, understand if a business is thriving or struggling or somewhere in between, right?
Exactly.
Okay. So before we get into the details of, financial statements and all that, let's talk about the different types of businesses out there. The textbook mentions proprietorships, partnerships, and corporations. Can you break those down for us?
Sure. So a proprietorship is the simplest form of business. It's just one owner. Easy to set up, but the owner is personally liable for all the business debts.
Oh, so that's risky, right?
Yeah, definitely riskier. If the business goes bankrupt, the owner's personal assets are at risk.
I see. So what about taxes?
In a proprietorship, the business profits are taxed as the owner's personal income.
Okay. Straightforward, but risky. What about partnerships?
A partnership is similar to a proprietorship, but with two or more owners. They share the responsibilities and also the liability.
So still pretty risky.
It can be, yeah. But it can also be a good option for small businesses, especially if the partners have complementary skills.
Right, makes sense. And then we have corporations, which always seems so much more complex.
Corporations are a bit different. They're considered separate legal entities. So they have limited liability, which means the shareholders can only lose the money they've invested in the company.
Okay, that's a big difference. So their personal assets are protected.
Exactly. It's one of the main advantages of forming a corporation.
That makes sense. And I imagine this difference in liability is something that we need to keep in mind when we're looking at a company's financial statements.
Oh, absolutely. It can affect how a company approaches debt, for example.
Hmm.
A corporation might be more willing to take on debt because the risk is shared among the shareholders and not just falling on one individual owner.
Interesting. Now, the textbook also mentions different accounting standards. Um, there's IFRS and ASPE. What's the difference between those?
Think of it as different rule books.
Rule books.
Yeah. Generally accepted accounting principles, or GAAP, is like the set of rules that guide accounting practices and ensure that financial information is presented accurately and consistently.
So everybody's playing by the same rules.
Exactly. And in Canada, publicly traded corporations have to follow IFRS, which are international standards, while privately held companies can choose between IFRS or ASPE, which is It's more tailored to smaller businesses.
Okay, so IFRS is like the international rule book, and ASPE is more for the local teams.
That's a good way to put it. And whether a company uses IFRS or ASPE can impact how their financial statements look.
Got it. So that's something to keep in mind when you're comparing different companies.
Absolutely. But regardless of which standards they use, the goal of GAAP is always the same: to ensure that the financial information is reliable and useful for decision making.
Okay, so it's all about making sure the information is trustworthy. The textbook mentions some specific principles within GAAP, like the cost principle, going concern assumption, and materiality principle. Can you give us a quick overview of those?
Sure. So the cost principle states that assets should be recorded at their original purchase price, even if their market value changes over time. So if a company buys a delivery truck for, say, $50,000, it'll stay on their books at that price.
Even if the truck is later worth more or less.
Exactly. This helps to prevent companies from, artificially inflating the value of their assets. Then there's the going concern assumption, which assumes that a business will continue to operate indefinitely.
But businesses fail all the time.
They do, but this assumption allows us to make certain assumptions when we're preparing financial statements. For example, we can depreciate that delivery truck over its useful life, assuming the company will be around to use it for that entire time.
Makes sense. But what if the company I is in trouble? Like, say they're facing a huge lawsuit or something.
Well, if there's significant doubt about a company's ability to keep operating, then that has to be disclosed in their financial statements.
So the going concern assumption isn't always valid.
Right, and when it's not, it can significantly change how we look at a company's financial picture.
Got it. Okay, what about that last one, the materiality principle?
Materiality is about using common sense. It recognizes that not every financial detail needs to be tracked super meticulously. It's about focusing on the information that really matters. Like, if a company buys a stapler, they don't need to record it as an asset and depreciate it over 5 years. They could just expense it immediately because it's not going to make a big difference in their overall financial picture.
It's like sweating the small stuff versus focusing on the big picture.
Exactly. Materiality is all about, keeping things in perspective. It's about focusing on the information that's actually relevant for decision making.
This is making a lot more sense now. We've got the basics of accounting down, the different types of businesses, and some of the key GAAP principles. Now, let's get to the really good stuff, the 4 financial statements.
Ah, yes. This is where the story of a company's financial performance really comes to life. Each statement provides a different piece of the puzzle, and together they paint this comprehensive picture of how the business is doing.
All right, I'm ready to put on my detective hat and solve this puzzle. Let's start with the income statement. What can we learn from that?
The income statement is like a company's report card. It shows how much money they made, their revenue, and how much they spent, their expenses, over a specific period of time.
So like a month or a year?
Exactly. It tells us if the company's profitable, meaning they earn more than they spent, or if they're operating at a loss.
Okay, so if their revenue is higher than their expenses, they're doing well. If expenses are higher, not so much.
Right. And the income statement breaks down those revenues and expenses into different categories, giving us a clearer view of where the money is coming from and where it's going.
Got it. So that's the income statement. What about the statement of changes in equity? That one sounds a bit more complicated.
It might sound complex, but it's really about tracking the owner's stake in the company. It shows how much they've invested, how much profit they've reinvested, and whether any profits have been paid out to them as dividends.
So it's like following the money trail of the owners.
Exactly. And then we have the balance sheet. This is often seen as the most important financial statement
Oh, why is that?
because it's a snapshot of the company's financial position at a specific point in time.
Mm,
It's based on that fundamental accounting equation we talked about. Assets equals liabilities plus equity.
right. That's like the golden rule of accounting.
It is. Think of assets as everything the company owns. Things like cash, inventory, equipment, property. Liabilities are what the company owes to others, loans, bills they need to pay, and so on. And equity is the owner's stake in the company.
So the balance sheet is a snapshot of what they own, what they owe, and what's left over for the owners.
Exactly. And finally, we have the statement of cash flows. This statement is all about the movement of cash, the lifeblood of any business.
I guess it makes sense. Cash is king. So the statement tracks all the cash coming in and going out of the company.
Exactly. And it breaks it down into 3 categories. operating activities, investing activities, and financing activities. So you can see where the cash is coming from and where it's being used.
Wow. Okay. So we have the income statement telling the story of profitability, the statement of changes in equity showing how the owners are doing, the balance sheet providing a snapshot of the company's financial position, and the statement of cash flows tracking the all-important cash flow.
It's all starting to come together, right?
Yeah, I'm starting to see the big picture. But how do we actually create these statements? How do we go from, day-to-day business activities to these neat and tidy financial reports?
That's where transaction analysis comes in. And lucky for us, the textbook uses our favorite fictional company, Big Dog Car Works, as an example.
Big Dog Car Works. I love those guys. So transaction analysis is about looking at each financial decision a company makes and seeing how it affects their overall financial picture.
Right. Remember Big Dog buying that new tow truck? We saw how that impacted the basic accounting equation assets equals liabilities plus equity. Transaction analysis is about making sure that equation stays balanced with every single transaction.
So it's kind of like a puzzle, making sure all the pieces fit together perfectly.
Exactly. And we'll dive into the details of transaction analysis and how it all flows into those financial statements in the next part of our deep dive.
Can't wait. This is getting really interesting.
It is, isn't it? Accounting might not sound like the most exciting topic, but it's really the key to understanding how businesses work and how to make smart decisions.
So stick with us, folks. We'll be back after a short break to continue our deep dive into the fascinating world of accounting.
See you soon.
Welcome back. So last time, we kind of laid the groundwork, right? We talked about what accounting is, the different types of businesses out there, and some of those key accounting principles.
What we said, those GAAP principles.
Yeah, GAAP. And now we're going to take a closer look at the 4 financial statements.
Right. We're going to see how those statements, well, they actually tell the story of a company's financial performance. Kind of bring it to life.
Exactly. And to help us do that, we're going to follow our favorite fictional company,
Big Dog Car Works.
Big Dog Car Works Corp. Remember them? Just starting up, just bought a new tow truck.
Yeah. Financed part of it with a loan. Remember? They paid $3,000 in cash and took out a $5,000 loan for the rest.
Right, right. So let's see how that transaction and some others actually show up in those financial statements.
Oh, good.
Okay, first up, the income statement. Now, this statement covers a specific period of time, right?
It does. It's not just a snapshot. We needed to choose a time frame.
Okay, so let's say we're looking at Big Dog's income statement for their first month of operations, January.
January it is.
So this income statement for January will show us Big Dog's revenues and expenses for that month. And it'll tell us, did they make a profit or did they lose money?
Exactly. The bottom line net income or net loss.
Right. So let's say in January, Big Dog does $12,000 worth of car repairs.
All right, so that's $12,000 in revenue for the month. Not bad.
$12,000 in revenue. Okay, now what about expenses? What did they have to spend money on?
Well, they've got rent for their garage space. Let's say that's $1,500 for the month.
Okay, rent $1,500.
And then they have to pay their mechanics, say $2,000 in salaries for January.
Okay, salaries, $2,000. Anything else?
Utilities. Can't forget those. Let's say $500 for utilities.
$500 for utilities. All right, so if we add all those expenses up.
That's a total of $4,000 in expenses for January.
$4,000 in expenses. And their revenue was, what was it again?
$12,000.
Right, $12,000. Okay, so if we subtract the expenses.
That leaves us with a net income of, wait for it, $8,000 for January.
Wow. $8,000 profit in their first month. Not bad, Big Dog.
Not bad at all.
Okay, so their income statement for January is looking good. They're profitable. Now, what about the statement of changes in equity? How does that fit into this whole picture?
We remember, the statement of changes in equity is all about the owner's stake in the company.
Right, right.
So in Big Dog's case, the owner is Bob Baldwin.
Bob Baldwin, right.
Yeah.
So let's say Bob initially invested $10,000 of his own money to get the business started.
All right, so that $10,000 is his initial share capital, his contribution to the company.
His share capital. Got it.
Now, we also know that Big Dog had a net income of $8,000 in January.
Right, from the income statement.
Exactly. And that net income, it gets added to the company's retained earnings.
Retained earnings, which is part of equity.
You got it. It's the portion of the company's profits that they've retained. They haven't paid out as dividends.
Okay, so retained earnings increased by $8,000 because of Big Dog's profitable January. So does that mean that Bob's total equity in the company is now $18,000?
You're doing the math. Yes, it is. His initial investment of $10,000 plus the $8,000 in retained earnings, that equals $18,000 in total equity.
Wow, okay. And if Big Dog had decided to pay out some of those profits to Bob, as dividends, then that would have been subtracted from the retained earnings.
Exactly. But in this case, let's assume they didn't pay any dividends in January. So the statement of changes in equity clearly shows how the net income and any dividend payments affect the owner's stake in the business.
It does. Okay, let's move on to the balance sheet. Now, this statement is like a snapshot, right?
Exactly. It's a picture of the company's financial position at a specific point in time.
So like a freeze frame.
Yeah, think of it like that.
Okay, so let's take a snapshot, a freeze frame of Big Dog Car Works at the end of January. And we'll use that basic accounting equation. Assets equals liabilities plus equity.
All right, let's do it. So starting with assets, we know they have the tow truck, which cost them $8,000.
$8,000 for the truck. Check.
Then let's say they also have $2,000 in cash on hand.
Okay, $2,000 in cash.
And they have some customers who haven't paid them yet for repairs. We call that accounts receivable. Let's say that's $1,000.
$1,000 in accounts receivable.
And finally, let's say they have $500 worth of supplies, oil, spare parts, that kind of thing.
Okay, so their total assets are, let me see, 8,000 plus 2,000 is 10, plus 1 is 11, plus 500 is 11,500.
11,500 in total assets. You're getting good at this.
Thanks. Okay, now what about liabilities? What do they owe?
Well, they still have that $5,000 loan for the tow truck.
Right, $5,000 for the loan.
And let's say they also owe $1,000 to their suppliers for parts they purchased. That's accounts payable.
Accounts payable, $1,000. So total liabilities are $6,000.
You got it. Now, to make that accounting equation balance, what does their equity need to be?
Okay, so assets are 11,500, liabilities are 6,000. So that means their equity must be 5,500.
Exactly. And if you remember, we saw that same number on their statement of changes in equity. Bob's total equity at the end of January was $5,500.
Wow, it all connects. It really is a perfect snapshot of their financial position at that moment.
It is. A snapshot that, is constantly changing as they make more transactions. All right, let's tackle the last statement, the statement of cash flows.
Okay, the statement of cash flows. This is the one that tracks where the cash is coming from and where it's going.
Exactly. It's all about those cash inflows and outflows.
Right. And we're looking at operating activities, investing activities, and financing activities.
You got it. So let's start with operating activities. For Big Dog, this is mainly the cash they get from customers for repairs and the cash they pay out for, the regular expenses like rents and salaries.
Okay, so for January, they received $12,000 in cash from their customers. And they paid out, $4,000 in expenses. So that means their net cash flow from operating activities is $8,000.
Positive $8,000, which is great. It means they're generating enough cash from their core business operations to cover their expenses.
That's good news for Big Dog.
It is. Now, what about investing activities?
Well, they bought that new tow truck, right?
They did, and that was a big investment. They spent $8,000 on that, so that's a cash outflow.
So negative $8,000 for investing activities.
Right. And lastly, we've got financing activities. This is where we see the impact of that $5,000 loan they took out.
The loan for the tow truck? So that would be a cash inflow, right?
It is. They received $5,000 in cash from the loan.
So positive $5,000 for financing activities. Now, to get the overall change in cash for the month, we need to add up the net cash flows from all three activities.
All right, so $8,000 from operating, minus $8,000 from investing, plus $5,000 from financing.
Equals a net increase in cash of $5,000. And if we go back and look at their balance sheet, we can see that their cash balance did go up from $2,000 to $7,000 during January. So it matches.
It all ties together. The statement of cash flows shows exactly how that cash balance changed over the month, where the cash came from and where it went.
Wow. This is really fascinating. We've gone through all four financial statements for Big Dog Car Works, and I can see how each one gives us a different piece of the puzzle.
They do. And together, they give us a really clear picture of the company's financial performance and their financial position. But there's one more thing we need to talk about when it comes to analyzing financial statements.
Really? What's that?
The notes. The notes to the financial statements.
The notes.
Yeah, they might not sound that exciting, but they're super important.
Okay, tell me more about these notes. What are they?
Think of them as the behind-the-scenes commentary for the financial statements. They give us extra context and details that can really help us to understand the numbers better.
So it's like getting the director's cut.
Kinda. They can tell us about the company's accounting policies, any significant events that happened during that period, details about debts, leases, even potential lawsuits.
So they can reveal information that's not, immediately obvious from just looking at the numbers themselves.
Exactly. They help us get the full story, the complete picture.
Okay, I'm starting to see why they're important. Can you give me an example?
Sure. Let's say Big Dog is leasing their garage space instead of owning it. The notes to the financial statements would give us all the details about that lease agreement. The terms, the monthly payments, how much longer the lease runs.
Oh, okay. And that's important because
Well, that information helps us to understand Big Dog's long-term financial obligations.
got it. Got it. So the notes are like footnotes, right? Giving us more context and insights so we can make better decisions.
Exactly. They add depth and nuance to the financial story.
Hmm.
They're essential for anyone who really wants to understand a company's financial health.
Wow. This whole deep dive is really eye-opening. I used to think accounting was just about, crunching numbers, but it's really about understanding the story behind those numbers and then using that information to make smart decisions.
I'm glad you're seeing that. And the great thing is, once you learn how to read these financial statements, you can apply that knowledge to any company you're interested in.
So it's like a superpower.
It is. You can look at a company's financials and say, hey, I know what's going on here. It's a really valuable skill to have, whether you're an investor, a business owner, or just someone who wants to understand the financial world better.
Okay, so we've covered a lot of ground here. We've looked at the four financial statements in detail. We've seen how they all fit together using Big Dog Car Works as a real-world example. We've even talked about the notes to the financial statements. So as we move into the final part of our deep dive, what's the key takeaway you want our listeners to remember?
I want them to understand that learning about accounting is about empowering themselves. It's about being able to look at a company's financial statements and really understand what's going on. It's about seeing those numbers as a story, not just a bunch of random figures.
So it's about taking control, about not being intimidated by the numbers.
Exactly. And, don't let this be the end of your learning journey. There's so much more to discover.
Right. Go out there and explore.
Yes. Look up the financial statements of companies you're interested in, read industry reports, keep learning.
This deep dive has been an incredible journey, and I hope it sparked a new interest, a new curiosity in our listeners. Because the more you know about finance, the better equipped you are to navigate the world of business, and the more likely you are to achieve your financial goals.
I couldn't agree more. Thanks for joining us on this deep dive into the world of accounting.
All right, welcome back to the show. So we've come to the end of our deep dive into the world of accounting. We've really covered a lot of ground, haven't we? From that basic accounting equation all the way to those complex financial statements and even those notes that give us even more detail.
We have. And I think what's really cool is that, we didn't just define a bunch of terms. We connected them to real world examples. Using Big Dog Car Works, we saw how financial decisions, they actually show up in those numbers on the statements.
Yeah, it's not just about knowing the definition of an asset or a liability, right? It's about understanding how they all work together and how those numbers tell a story about the company's financial health.
Right, exactly. And that understanding, it can be incredibly empowering. Imagine, you're thinking about investing in a company. Well, if you can analyze their financial statements, you can get a real sense of how profitable they are, how much debt they have, their cash flow, all these things that contribute to their overall financial strength.
Or maybe you're thinking about starting your own business. Understanding these accounting principles can help you make better financial decisions, manage your cash flow, and ultimately, increase your chances of success.
Absolutely. And even if you're not an investor or an entrepreneur, having this basic understanding of accounting, it can make you a much smarter consumer. You can look at a company's financial statements and get a sense of, their stability, whether they can actually deliver on their promises.
It's like we've learned a secret language, the language of business.
Yeah. Yeah, it is a bit like that. And the best part is anyone can learn it. It's not rocket science. It just takes a little bit of, time and effort to grasp those core concepts.
So as we wrap up this deep dive, what's the one key message you want our listeners to walk away with?
I want them to remember this.
Yeah.
Financial statements, they're not just a bunch of numbers. They're a narrative.
Hmm.
They're a story about the company's financial journey. And by learning to read that story, you unlock this powerful tool for understanding business and for making informed decisions.
So don't be scared of the numbers,
Yeah,
right? Don't be intimidated by those spreadsheets. Dive in, explore, and see what you can learn.
exactly. And this is just the beginning. There's a whole world of financial knowledge out there waiting to be discovered.
So much to explore.
So take what you've learned in this deep dive and go out there and apply it. Look up the financial statements of companies that you're interested in, read industry reports, and just keep learning.
This deep dive has been a fantastic journey, and we really hope it sparked a new interest, a new curiosity in all of you listening, because the more you learn about finance, the better equipped you'll be to navigate this complex world of business and to reach your financial goals.
Couldn't have said it better myself. Thanks for joining us on this accounting adventure.
We'll see you next time.